this is a follow-up of UPL presentation that Sanjeev sir did at our 2020 event last week. So most of you would have seen, and there are quite a few asked even at that point of time. Like, in fact, Sham, right after the presentation, like 2 minutes after the presentation, he sent a note saying that we should have a longer session, and whatever he presented cannot be condensed in 20 minutes. So that was the reason why we wanted to have a longer session. So as most of you would know by now, Sanjeev sir was the CFO of SRF, a similar company, right? And he has worked in multiple other places where he has brought down debt from very, very high levels. So over to you, Sanjeev sir. You can start now, I guess. Vignesh, you can share it. Yeah, it's appearing. Yeah, fine.
So just the disclaimers. I am not SEBI registered, and I have a position in UPL. Okay, my background, my approach to investing, I have been known for calling cyclicals at the bottom of the cycle, again and again. And this is, the first time I'm attempting a secular business transformation story, where I'm trying to recognize a caterpillar before it becomes a butterfly. I have a feeling that there are mistakes. So besides my CFO background, one of my private pursuits over the last 25 years has been that I have focused a lot on behavioral economics. I've accumulated more than now at last count, almost 800, 900 flawed mental models that we use, often, because of various evolutionary reasons. So our subconscious is all messed up, and we are not very rational people. So it starts with the central assumption that human beings are flawed. We are really monkeys with laptops in our hands. My favorite term is this, that andar ka bandar is what I like to use in my lectures. So we've documented these models of flawed thinking, and and I use it in my investment hypothesis. So I will point every investment hypothesis finally a disagreement with the market. So you've got to point out some flaw that is embedded in the market's perception of a particular stock. And obviously you've got to be right. The market subsequently has to agree with you. The advantage you have is that if the market doesn't agree with you, the perceptions will change along with the facts. It's all right. A stock will keep doing what it has to do. A business will keep doing what it has to do. And it's just going to refuse to go away. So the caterpillar will keep turning into a butterfly whether you like it or not. We used this kind of a mindset in SRF. We disagreed with the market about our classification as a commodity chemicals company. And today, 20 years later, you can see that SRF from some 0.3 times book value is God knows where it is. Last I heard, I think it is about 25 times EBITDA right now. Peaking at about 30 times EBITDA. So now you have an entire commodity chemicals company classified as a specialty chemicals company. And as an ex-SRF person, even I can't understand what the market is thinking now. So anyway, that's a different story. Here, what is it that we noticed about UPL? First, it is among the most disruptive industries that is going to change the economy. Clean tech is obviously, there's a lot of talk about how clean tech is changing energy, how it is changing transportation, how it is, but the third, probably the most important place where clean tech is going to have a huge impact is going to be agriculture in general. So that's where I feel we're already seeing that agriculture, food prices are at an all-time high, soft commodities seem to be on a secular growth path. Commodities, as you get an excess of dollars and you get an excess of monetary stimulus, which is what the world is going through, is basically inflation is going to be driven by commodities in general, and specifically agri-commodities. We are going to see food shortages, etc. So long story short, agriculture is the right place to be in. My second, constraint is that I always look for country, the natural ownership of a country, which means even in my steel hypothesis, I said that the natural owner of this business is India, based on the fact that input processing and output, which means markets, are all embedded very close to each other, and logistics in steel is obviously a very, very big entry barrier. In India, this is even higher in case of a research-oriented subject like agrochemicals. Agrochemicals is really pharma. There's very, very little difference in the dynamics of the two industries. So for the same reasons, India, just the way India is the most competitive country and the final destination of all pharma production, I would argue that India, thanks to its, the fact that we are one of the best agrarian nations in the world, number one, and number two, in terms of processing cost and, intelligent engineers, India is one of the most, is the most probably competitive place to produce out of. So manufacturing and, shall we say, experimentation and innovation, with the variety of soils that we have, the kind of practices that we have, the impact on production of unit bio input is going to be among the highest. Here in India, the other ones are Latin America and Africa, of course. The third one is the SRF element, which means that in a complicated industry dealing with complex products, process innovation is going to be the differentiator. So look for a company with a culture of process innovation. That's the management input. Then in case of, and this is something we noticed specific to UPL, the elements of moat. UPL is one, just in using pharma language, just imagine that a company sets up a vision to be an Aurobindo Pharma, which means a generic low-cost producer, plus a Pfizer, plus an Apollo Hospitals, plus an Apollo Pharmacy, plus an Apollo Munich Insurance. So just imagine that a company has this kind of a vision and gets anywhere close to delivering that in pharma. Now, pharma, since most people track it and track individual parts of the value chain, this is going to hit you. But you've not noticed that in a much smaller industry, agrochemicals is only $63 billion. And maybe if you can include another $200 billion of fertilizer, it's at best a $250 billion combined bio input industry. So that's my new name for the agri and for the agrochemicals and fertilizer industry, because everything I feel, I'm thinking that there's going to be convergence. We already have, nano fertilizers coming up in fertilizer. Very soon, these two industries will start looking the same, at least as far as the complexity of the molecules and the customization with soil conditions is concerned. So then what else would I be looking for? That company growth. So all this has to show up in the numbers. So company growth should be greater than global growth with an increase in global market share. The UPL, of course, has kind of doubled its market share in the global market share in the last 5 years, thanks to the Arista acquisition. Then generically, company growth should be higher than industry growth, and it should be an industry which is becoming more and more important to society, so that the industry growth should be more than GDP growth. So given all this, absolute levels of growth that I look for, I should be getting at least 15% EBITDA growth with concomitant sales growth, improving balance sheet and debt metrics, which means rising capital efficiency. What does that mean to me? Return on marginal investment should be higher than historic return on average invested capital. Okay, so UPL meets all of these criteria. Come what may, my constraint is I am not going to pay more than 6 times EBITDA for, whatever, however beautiful the company is. I'm not. So you will get these companies with these characteristics, but you'll get them at, say, 20 times EBITDA, 40 times EBITDA, something like that. Okay. So the important thing is that going forward, as the new molecules come in, India, with its agricultural diversity and its very low levels of crop protection usage, remember, as these products turn, biosimilar, or they turn into biosolutions, and they turn, more and more, shall we say, on absorbability and basically they come in line with how the human body operates. You are going to see higher and higher usage, which a bigger and bigger impact on those countries which have better soil conditions. So in India, we are going to see, we are one of the best. We simply have one of the best. I'll just give you a little tidbit. It's there elsewhere in the presentation, that with 50% extra rainfall, India has 50% extra rainfall. So you can say China has, say, 50% of India's rainfall. 10% of acreage. China has 40 times the crop protection chemical usage per acre, and 2.5 times the fertilizer usage, to get an agriculture sector that is just twice that of India. So you can imagine, if India gets going and these practices start to come up in India, the kind of increase in agricultural productivity is going to be the highest. There are other places. Africa is another place where the impact of these inputs is going to be huge, and they are going to turn into big agricultural nations. LATAM, of course. It's very important here, cut all of this. Which company, whether in pharma or of course in agri-chemicals, is suddenly saying that I'm going to forget what I can produce, and I'm going to focus on building client relationships and understand the client's problems. In very few industries do you see that people give up their, it's very difficult for a company culturally to do that, give up their product focus and process focus to focus on what is the client's needs. UPL has taken upon itself, through its Open Ag initiative, the job of focusing on understanding the client, the kind of grainy data, farm by farm, segment by segment, soil health by soil health, or soil conditions by soil conditions, farming practice by region. The kind of data they will get will help them to customize solutions which may not be produced by themselves. They are now controlling the entire ecosystem. So it's already visible. Anything that goes off patent, just drops into UPL's laps. So this solutions focus is what is really the butterfly part of the story. That any company that gets in there is going to outperform. So this is the part that is just not there in the valuations of the company, just not even there in the perceptions of the market, that anybody is even trying to do such a thing. So in the next slide, Vignesh. One second. No, Vignesh, not Arista. Go up. Yeah, the sector story. So global agriculture, this is the big trend. Global agriculture is going to be transformed. You can see that a market leader like UPL already has 30% of its entire product portfolio, their entire sales, coming from what they call sustainability solutions. So this is going to be a wider trend. Dirty chemicals are going to close down, and you're going to have more and more of biosolutions. Important agrarian regions are going to emerge, and there will be some kind of specialization, some kind of country ownership. South Asia, South America, and Africa are going to emerge as the major agrarian hotspots, where there will be sharp rises in productivity, along with these bio input industries and the conversion of fertilizer and crop chemicals into solutions for agriculture. Both fertilizers and crop protection are going to turn into interchangeable subsectors. So industry size is going to expand and the dynamics of the industry are going to look very similar to each other. The agricultural value chain is going to be disrupted. Control over active ingredients will turn organic and hence available. So you are going to get a very different set of drivers for outperformance in the industry. So we are looking at the industry at the cusp of major change. India is one of the most competitive. It's already visible. We are filling in wherever there is a food shortage. I mean, we used to be the basket of the world, the basket country of the world, and today we are, one of the most important agrarian nations. Thanks to UPL, we have the most integrated manufacturers. Others are also going to pursue similar strategies. So at least as far as the country is concerned, we are going to see a kind of a IT industry equivalent emerge, where ecosystems of innovators and integrated manufacturing are going to come up. We are fortunate to be having the largest variety of crops. We are unfortunate enough to have the largest amount of crop losses. We have the largest variety of indigenous active ingredients. That's just simply because we are fortunate enough to be living in a rain-fed area with a very wide diversity of soils. Plus we are of continental dimensions. And therefore we have the largest potential improvements in productivity. So leadership in India is going to decide leadership across the world. This is an indication towards Europe, where all those guys who were innovators, they are getting into trouble because of their Europe being Europe-centric. I'm referring to BASF, Bayer. We just had BASF close down their biggest specialty chemicals plant. So this is part of a broader trend. Next. Generification, which means that a large number of molecules are going off patent. This is the 6 billion in a $63 billion industry. So 10% of molecules are going to go off patent within the next 3 years. And along with that, you have this shift that the new molecules are all coming up with very, very small customized construction, biosolutions. And in Europe, particularly, if you get a new molecule which is bio-friendly, they are going to ban the old molecule. So that's a threat that is there over the entire patent regime existing in Europe right now. China versus India, I gave you the example of what just having land is not going to decide agricultural productivity. And this is most important with this kind of specialization. The cost of agricultural produce is going to start following normal, country competitive metrics. Just like steel, some countries are more competitive, and so China is going to lose, importance and is going to turn into a net importer. So this is all building up the case that crop protection is going to see material change, and in this sector as a whole, we are going to see some people driving the thin end of the wedge, the front end of the chain. Indian yields have grown in the last decade, but they still remain way below global averages. As India reaches parity, thanks to better fertilizer and crop protection usage, we are going to sort of level out the productivity differentials. Climate sensitive will, of course, sensitivity will, of course, remain a global priority. So customization of these chemicals will continue. Next. So what is UPL? UPL is actually an ecosystem. Next. So in let's say they've done, I've managed to find about 53 acquisitions done in about 50 years. And I think they've done 25 acquisitions in the last 5 or 7 years. So they continue to be very, very acquisition driven. They're putting together, it's a Lego brick kind of construction. They're putting together an entire ecosystem. So this is something you've got to always keep a wary eye on. The market is usually very suspicious of acquisitions and whether they really create value. In UPL, you will know, I am asking you to notice that this company is very good at integrating acquisitions, at locating and integrating acquisitions. So they have a good track record in building value. The big one that they did, which is easy to analyze, is Arista. How quickly they've taken Arista, extracted the synergies from it. The sum of the parts is greater than the whole. Basically, the horse bought a horse, and together they had access to a cart. And now the cart is basically adding bells and whistles. So capital productivity is going to explode thanks to this, the successful integration of the Arista business. Okay, next. So what is UPL? UPL is really, you think of it like a wedding cake. At the bottom, its superior process comes from, supply chain efficiency. The fact that UPL has grown very good at global sourcing, reduced over dependence on China, particularly in case of yellow phosphorus, and has gone into multi-country sourcing. Along with that, they have excellent integrated manufacturing, 19 plants spread across India. Along with, they've got quite a few other plants acquired through Arista. But everywhere now their production allocation decisions, and especially, the customization and formulations business has improved because they are able to choose the right country and the right, product mix match. Something that, barring the largest players in the world, nobody has the kind of global spread that UPL has. As a result of this, anything that is going out of the patent regime is going to fall into UPL, the UPL slab. UPL is already, by the way, the largest post-patent producer in the world. So they've already achieved global leadership, and this is going to get consolidated. Formulations and biosolutions have already dwelt upon it. This is a sector-wide trend, and a guy who is able to get a huge cafeteria. UPL has 14,000 products in its range already. So they have, given how they are able to, given that they have a cafeteria of which is so large and so diversified, plus they have joint ventures and relationships with the molecule on innovators right now. They are the best person in the world, the cheapest process for getting registration, product registrations, and compliance. This is a very, very important part of the agrochemicals business, because every country has its unique rules and its unique, crop conditions, unique farming practices, unique soil health, soil patterns, etc. Then, of course, there's a patent cliff that the industry is eventually going to see about at least 15% of the generified as products go off patents. In products and registrations, I've already said that thanks to the Arista process, they are number one in the world. And then, of course, OpenAg. OpenAg is that process that they have built on top of the UPL production, the formulations and the product registrations process. So now they are accumulating data that only they will have, that none of the innovators will have. So they're sitting at in the middle. They could outsource innovation to somebody, or they could start doing it themselves. I believe that they will eventually pull innovation, new molecule innovation and customization into the company. Although that is going to create antitrust issues, I'm told, somewhere in the world, particularly in Europe. But if it's not an acquisition, it will be some kind of a joint venture or some kind of a close relationship or exclusive marketing rights that they will start getting. So their control over data and customization and individual relationships with the farmer, which will happen because of that platform, will eventually describe the company. Eventually, you will forget that UPL is an efficient, buyer of soft commodities, is a good manufacturer of products. You'll forget all of these. You will just remember that it is a great distributor and customizer of individualized solutions for the farming sector. New molecule discovery is what we have to watch out for. This, I take it from market short, because the market thinks short term. I take it as a risk that they might, do another acquisition as the debt falls off. I'll come to the debt. The debt seems to be misperceived by the market. So what are the divisions that you're getting? You're getting biologicals, which is, NPP, they call it. Seeds, which is Advanta. Traditional crop protection, which was the original UPL. Soil and water technologies, which is OpenAg. Formulations, which is Arista. Pre and post-harvest solutions. That's another thing. UPL is the only company which is focusing on post-harvest, storage and warehousing of crops. So increasing the longevity of perishables. That's Deco. That's a business which has huge optionality. It can just go anywhere. Plus, they have all those 14,000 registrations. So, would you call this a company or a set of processes, layered set of processes? Global market share is now running at anything between 9 to 11% across different products. And given the way they are gaining share in the market, you can expect this to consolidate. Nurture Farm is another initiative with a certain amount of optionality in it, and they're getting into offering solutions rather than products. This I've said. Okay, yet another initiative that they have is given that the farm sector is one of the biggest contributors to global warming, how about getting carbon credits, being an intermediary to get carbon credits for the farming sector? You can imagine what a high margin product that is going to be. They are going to make money on changes in practices in the farms. So how big is that once the process gets going? Okay, and this is all going to be clean money. It's not going to take any kind of capital. So that's the story in UPL. In agrotech, Jignesh? Okay. So what are they doing in agrotech? This is a company slide. Identify promising innovations. Now, this is how a private equity player thinks, not a manufacturer with commercial potential. Invite these technologies and integrate them into the OpenAg Center. Now start incubating these technologies. Model technologies, match them with soil conditions and cropping practices, and then go to market, which means, to an innovator, you're saying that you don't have the ability to scale up the product to a global distribution, and I'll do it for you. So do it right the first time. All the mistakes that a new guy is going to make in taking his product global don't have to happen with the UPL. So obviously, a very robust and efficient pathway through the global regulatory system. And then things stabilize and there's a win-win. So the molecule innovator now becomes a part of the UPL value chain. The Arista acquisition, I'm just addressing it because this is one of the big misperceptions of the market, that the Arista debt has not got paid off. That is completely wrong. Most of the Arista debt is on target to getting paid off. I believe only about 1 billion of the Arista debt is left. What you're seeing is that the rise in market share, the doubling of global market share that happened when UPL and Arista got together, created demand for working capital. So what you are seeing is working capital debt, along with a few one-offs, which mainly happened because Brazil hardened interest rates and off-balance sheet debt became very expensive, so they took it on balance sheet. That was a one-off. It's already gone. Brazilian interest rates are declining again. Liquidity has improved, so factoring non-recourse factoring lines are again available. There are marginal credit losses in these. In the last 2-3 years now, this working capital portfolio has stabilized, and more important, it is getting paid off because you're paying it off with very, very high profitability EBITDA lines. If you're going to make 22% EBITDA and you're turning the money around 3 times a year, then you're getting a 70%. Basically, your payback is about 15 to 18 months. So in 18 months, the debt will be converted into equity, and you're going to see a sharp fall off, which is going to, I think, start from this quarter, because as Brazil goes off season, all that money is going to come back, and they've already admitted to it in the con call that there is going to be a sharp drop in working capital utilization. They've indicated about long term, they've indicated about $500 million of debt reduction, and they seem to be on target. So the key debate about UPL is their debt $2 billion, which is 16,000 crores, or is their debt, the Arista, the debt to be concerned about, just about $1 billion, which too will drop off next year. So all good. The only thing that didn't work out according to plan was the sharp rise in market share and the temporary block up of operating cash flows into debt. So that's all. There's nothing to be concerned about. And I feel that the market is misperceiving this, which is why you're getting it cheap. I mean, remember, all this is coming to you at some 4.5 times EBITDA, depending on how you define the debt. If you're going to gross up the entire debt and include factoring lines and working capital debt in it, that's like including bank deposits and trying to into the EV of a bank. So think about it. I feel that the market is making a very, very big mistake in perceiving the debt. Okay, next. See how in the recent past, the company has kind of doubled its turnover. Okay, revenue growth has run at an average of almost, I mean, they've run comfortably above 15%. EBITDA growth has followed. But what is most important is their conversion to operating cash flow. And as you can see, this debt of 22,000 crores that they are showing, the current year's numbers for non-recourse factoring have been indicated at about $1.3, $1.4 billion. So we've shown that in non-recourse factoring debt. So this debt is what the market is grossing up to UPL's working capital debt, and coming to the conclusion that therefore debt has not fallen off. So take your pick. This is the disagreement that we can have with the market, that all of this debt has changed character. It is sustainability capex, it is working capital debt, not acquisition debt. The acquisition debt has been replaced qualitatively by superior debt metrics, the payoff of which is going to come from the receivables portfolio of the company, not from operating. It doesn't have to come from operating EBITDA. So this is the most important argument about the cheapness of the company. You can see that from a peak of 3.73 in March 19, net debt by EBITDA, today they are, depending on how you take it, they are at 1.35, well under, a good credit, etc. So debt is under control. My central argument in choosing UPL is that the so-called debt concerns seem to be clouding the market's perception about the company and its valuation. And that's the central argument. So this is where I would want, all of you to, you can even talk to me directly, and let's debate this. Okay, then let's move on to the next slide. What kind of company are we now looking at?
Sure.
So there's another subplot going on in this valuation argument, that because the market is not respecting UPL's potential and not giving it the right value. Remember, they took over Arista for 9.5 times EBITDA. And if you treat UPL as a near debt-free company, then you're getting it for 5 times EBITDA right now. So some part of it can be attributed to higher interest rates, because this is a global company that we are talking about. So let's say the baseline valuation should have been 8. But right now, for various structuring reasons or the fact that the market makes mistakes, you're getting this company for 5 times. Okay. Vignesh, next slide. I have tried to take different kinds of companies, and this is where the big debates are. This is where I will want intelligent people to come back at me and try and argue out perceptions, because you can't argue about the facts. You can argue about biases. So this is where you draw an opinion from the same underlying facts. I am arguing, this presentation will be circulated, so please come back to differ with me. I am arguing that UPL's cash flow conversion rate is rising and is among the highest in the industry, especially in its peer group. Whether you take even international players, I've taken FMC. You are going to get cash flow conversion of much lower levels. Places like Rallies India or Dhanuka Agritech, etc., or even global players like FMC have much lower cash flow conversion. So UPL's cash flow conversion, I've also put in Sun Pharma just as a kind of a benchmark, to argue that UPL is the Sun Pharma of the agrochemical industry, with an industry dynamic that is actually very, very similar. So cash flow conversion, which is how the market should be evaluating a stock and how it should be valuing a company, is higher than its peer group in the industry. But the market cap that UPL gets for its cash flow seems to be lower. That is because of a mistake that seems to be made in the definition of free cash flow. How are you converting free cash flow from operating cash flow? So this seems to be the core of the debate. And this is where, it's a deep point to make, and I don't think I can make it, just in a single presentation. This is where I want to set up a series of debates to change perception. As this happens, you're going to see a very sharp change in the valuations and the recognition that UPL could be, Sun Pharma, for example. Just take a look at those numbers. Sun Pharma has a valuation which is 3.5 times that of UPL. Okay, we've taken the most extended, valuation of UPL at say 7 times EBITDA. But I'm arguing that what you're seeing at 7 times EBITDA will actually turn out to be 5 times EBITDA. So Sun Pharma is rated at 4 times above, despite very, very similar characteristics, and most important, very, very similar ROMI, very, very similar return on marginal investment, with a very structural bias. Delta EBITDA is not going to come with a lot of delta investment. So that's the nub of what I'm trying to say. Okay, next. Let's move on.
Yeah, I got the slide SOTP valuations. Can you see that?
Yeah, this is where you can play around with your own numbers. Just take the dynamics of, I can't see it, play around with these numbers. That the EBITDA, we've estimated a certain growth rate. You can build your own opinion about these growth rates, but these have been visible over the last 4 or 5 years, and these are accelerating. Arista is doing way better, but we've taken a conservative numbers. So then you take FY23 EBITDA and decide what EBITDA multiple you want. There is already benchmarks laid out in their placements with private equity, where far higher valuations have been attributed to parts of the business, principally Advanta Seeds and the India SaaS business are all valued way, way higher. So this is actually a fit case to be taken private or taken over by private equity, because it is so cheap, and retail valuations or open market valuations are lagging what private equity seems to know. So fit case for being taken private. Debt is the other part where I'm arguing that it's not 16,000 crores, it's more like 6,000 to 8,000 crores, and that too headed towards zero in the coming year. So that is it. So how do you value it? So this is just a valuation. This is, mind you, not a price target. So that's a disclaimer. Stress testing that when UPL was just a manufacturing company in 2014, before it launched into its new avatar, the EV by EBITDA was at 4.8. Today, there seems to be, coincidentally, there seems to be a lag in perception, where people are still treating UPL as the old UPL, even though it has significantly different dynamics. While UPL should be benchmarked along with the company, UPL is actually today more Arista. I mean, legally, UPL may have taken over Arista, but culturally and business model-wise, it is Arista that has taken over UPL. Going forward, UPL will look more and more like Arista and less like the old UPL. So the actual benchmark valuation should be the Arista valuation. And if you do that sensitivity, and if you admit to that this perception has to change, this is just a communication issue, it's not a reality issue, you're going to get this range of share prices. So this is my case, and I mean, this is where our disagreements, and we should trade our respective perceptions. Okay, next.
Is it visible? The market seems to know something.
Okay, that's a technical argument where I can't see this.
No, you can't see it. Okay. Is it visible now?
Yeah. So you can see the consolidation around while it is living through the fact that it is a global company. Initially, the perception was that it is going to be most hit by the rise in interest rates. Those rises in interest rates are already out of the way. They've already said that regardless of interest rate rises, interest cost is actually now in absolute terms is going to start reducing from this quarter onwards, and will continue into the foreseeable future. More importantly, Brazil, which was the real pain point, where interest rates went up from 5-6% to 15%, has already started to come off down to about 12% and falling. So liquidity is going to improve. So all of it, I mean, market seems to be obsessed with the debt. I don't know why you would think so much about debt in a company that at max is at 2 times EBITDA. So that change in perception has to be reflected in the public consensus. And for that, you have to shift to technicals. So we've gone through this period when the market has been fearful and, misperceived this company. And that seems to be, changing as the facts become visible. Now, when will the facts become visible? This quarter, if they achieve their debt reduction target, suddenly you're going to see a very, very different picture. And then you have to treat it like a sugar company. In a sugar company, we don't complain about working capital debt because we know it is seasonal. Same way, if you are going to have most of your sales targeted at Latin America and the Southern Hemisphere, you are going to get your a peaking of working capital, which will come off, towards March. So you've got to see it year to year. Not even that, because it's dependent on the composition of the markets that you are, where you are pursuing sales growth. Okay, so this, is there any other slide left?
No, just the thank you slide. Is it visible now?
Okay, so that's it. So any questions?
Yeah, I can.
So we're calculating all this.
You can raise your hand. I'll let you to talk and ask your question if anything is there. Okay. Yes, sir. Please go ahead.
Yeah, hi, Sanjeev ji. Thank you so much for the presentation. Really useful. My only question is, I don't know UPL in that amount of detail as you do, but whenever I've spoken to sell-side analysts and other co-fund managers about this company, the only 2 words I get to hear is corporate governance. Apparently, there are significant issues, and if I'm sure you are in the know of things. So, can you talk about what are the perceived corporate governance issues here, and how, as an investor, would you deal with them?
Okay, Aditya, I must bring into into center stage our running kind of debate about these corporate governance. I've talked to you about Sun Pharma also, and argued that I tend to look at it from a CFO's perspective. So I look at the convenience of business rather than market. Market tends to paint everybody with the same brush. So market tends to think that everything is going to turn into a DHFL or an ILFS. While, sometimes that is not correct. And I've seen in my past that many companies, including my own SRF, went through clouds of corporate governance, which, we always knew that there was nothing really wrong. In case of UPL, I can trace this perception to two specific things. I like to focus on, the feedback of that whistleblower, which turned out to be, problems in the family, actually. Where allegations were made about money getting siphoned off, all related to a very minor, personal residence and the rent paid on that. So that had already been investigated, but the media picked it up as a story and ran with it. So there's always a delayed perception. What I will argue is that since then, UPL has had a credit rating upgrade, which means that their numbers have been checked. There was another story in the media which talked about the potential resignation of the auditors. What was very, disturbing about that is that KPMG, which was an ADI appointee, did not talk about, but this was the flare that went up in the media, that KPMG might be leaving. So number one, KPMG never left. Number two, RDI is not only there, but has rolled over their investment and taken up another investment. More than RDI, now Brookfield and a few other players are in different parts of the business. So accounting fraud, resignation of auditors, a credit rating upgrade, actual money movement, visible money movement of more than 10 to 12,000 crores. When I put it all together, I find that things just have to settle down. This is just a false alarm. You're going to hear less and less about all these things, and more of tie-ups with reputed investors, which obviously have gone through much better due diligences than you and I can ever put in. So market perceptions go with a delay, and that's the opportunity. That I think is probably the single biggest reason why what should be going at 7-8 times EBITDA. So these are the two elements on which my story stands. One, that the debt is misperceived. That part I'm sure you will appreciate probably better than the corporate governance part. And two is, when do you not believe the debt? When do you have suspicion? When you don't basically trust the person. So it's the second, leg, the delayed perception of the market that seems to be driving this. So, well, that's where value is. If you join me in having that disagreement with the market, you're basically getting a free lunch of up to 60% upside in this company. That's my core argument, hypothesis. That's what I'm evangelizing right now.
Understood, Sanjeevji. Sanjeevji, just
one more thing. The debate will not get over. No discussion will change the debate, because the facts will keep changing. And, as long as you keep watching the facts, like I'm saying, that watch the fact that 2 sustainability loans have come, 1 credit rating upgrade has come, cash has moved. So if you watch all those things, then you'll find that this is not a DHFL or an ILFS in the making. I mean, I'm just taking some extreme perception just to highlight the point. Yeah. Sorry, Aditya, you were saying something?
Yeah, no, that's fair enough. Just one last question. When you mentioned the $2 billion debt that currently is on the books, is that gross debt or is that net debt?
No, that is net debt. That is net of cash.
Right. So then why do you say that, it's actually $1 billion and not 2? I understand your point that, let's say $1 billion of debt is going to be repaid in the next year or 4 quarters or whatever, 3 quarters. But, they still have to generate the cash to pay out the debt, right?
Yeah. No, so I am looking at it as generally debt, when does debt have to be paid from earnings? The part that the market often misses out is when debt has to be paid. This is where I find Reddington also mispriced. When debt can be paid from the balance sheet. So that is the part the market makes a mistake on. we all assume that all of this debt is long-term, acquisition debt or fixed asset debt, and is basically gone into a sunk cost and cannot be retrieved, by the simple self-liquidation of a balance sheet. So in UPL's case, what am I arguing? I'm arguing that if all delta debt is actually going into working capital through the acquisition of marketing networks, that is self-liquidating. In the first burst, as you enter a new market, maybe working capital is not under control. Not true of UPL. Working capital has been brought back under control. Credit losses are properly under control. So that's argument number one. Number two, if sales growth in an inflationary year, we've had frenetic sales growth and not concomitant EBITDA growth. Okay, so you have higher cost raw materials, you have higher cost inventory, and you have higher receivables. Now, all of this as inflation cools off is going to, stabilize in the same place, and you're going to have market share gains, which are going to come from volume growth, which they've already announced. Now, once that happens, you are going to get much better debt metrics. So anyway, going back to that if one part of the company, the distribution part of the company, is really a working capital bank, then you don't use EV by EBITDA to evaluate that. So all I'm saying is that the quality of the debt has moved, and that is not appreciated by the market.
Oh, so it's not about the quantum, it's actually the quality of the debt. So it's working capital debt.
Think of it like this, that if just a simplified argument, that if I'm making 22% with every churn in my books, so every 120 days I'm churning, say 22%, then in 1.5 years, my debt gets run off and gets converted into equity in 1.5 years. Okay, as compared to an acquisition where I don't even know what I'm going to do with that acquisition. So those debt metrics and the fears relating to that kind of debt is very, very different from acquiring a distribution network.
Understood, Sanjeevji. This is very helpful. Thank you.
Okay. Now, Mr. Satyanarayan.
Good morning, sir.
Yeah, morning.
So, I don't know much about this industry, but still, as India is an agrarian country, as you said, like one is the crop protection is the area to focus, right? What is the kind of edge this UPL is having in terms of crop protection without spoiling the environment? That is the usage of harmful chemicals and all.
Brilliant question. Thank God you don't know about the industry. Brilliant question.
I mean basically we are from agricultural background.
Okay.
So just thought of asking you that because ultimately, the crop protection should come from without harming the environment. Ultimately, that is going to be the roadmap for us, right?
Yeah. So you put your finger on a very, very important. I did cover it, but I don't think I emphasized it. That one of the biggest, I did cover this element of the story, but I don't think I emphasized it enough. One of the biggest, stories going on in crop protection generally across the sector is that everything has to turn bio-friendly. It has to, dirty chemicals have to go out and, bio-friendly. So you should be using, let's say, neem inputs, or basically clean chemicals as compared to so this is happening in pharma also. You have an entire biosimilars industry, you have an entire nanomedicine segment coming up where valuations are bigger and it is basically cleaner technology. So it's the same in agriculture. The new chemical entity regimes are going to take a back seat. And the biocell solutions, where there are smaller companies coming up with hundreds of innovations that are more bio-friendly. And Europe at least has said that whenever they see a biosolution, a bio-friendly product, they will ban the dirty chemical. So at least one major market is just waiting for these new technologies to come. Now, cut to India. India anyway starts with a situation where 25% of your crops are lost, simply because we just don't have crop protection chemicals. Our per acre usage is some 300 grams or something. China's is 40 kilos. So you can see that excess dirty chemicals, China seems to be dirty at everything. But India is starting from a good place. And we will straight away go to the person who's able to innovate biosolution. And that is a place where UPL is head and shoulders above the rest of the market. They are not only themselves focusing on sustainability solutions, but also bringing in other innovators into the same ecosystem and using them, leaving them with the innovation and basically distributing and handling the compliance processes across multiple countries, 138 countries to be precise. So that is this is one of the biggest trends that happens to be happening to agrochemicals, and UPL is at the front end, is at the thin end of the wedge. They are driving this change rather than suffering from it. So this drop in the performance that you're seeing of the old innovators, the distribution guys, the fellows who used to buy from the molecule innovators like FMC or Mitsui, etc., and distribute across India. The distributors are going to find it very difficult because UPL is both manufacturing and sourcing raw materials cheaper and customizing. So at all ends of the value chain, that's how UPL is building up the moat, by occupying all parts of the value chain.
Thank you, sir. Thank you.
And remember, these are all low capital, initiatives. You're going to get more and more money out of the intelligence embedded in these processes rather than the actual cash investment.
Okay. Now, sir, I just have a very basic question. What do you think are the risks in the story? What do you think can go wrong?
Okay, the one is the what happened between Aditya and me, which is actually the reason why I want to provoke these things. So Aditya put his finger on the right place. Corporate governance. When you have 318 subsidiaries, I am never going to find out if you are doing subsidiary to subsidiary sales. I have to I'm paranoid about their free cash flow. I will go all the way to Brazil to find out what is happening to factoring lines, what happened to credit costs over there, what kind of credit losses are there. It's so easy for UPL to just buy turnover and push it off balance sheet through a factoring line. So those are the places in a large global company with a cloud of corporate governance on it, you have to be paranoid about this. And I could be wrong at any moment. If I'm right up to now, I could be wrong tomorrow. The next acquisition may turn out to be a dud. So that's the problem with an acquisition-led strategy. It's what is the problem with the private equity fund, that your next investment could be a dud. So they will be investing in, say, molecule innovators. They will be getting into those kind of JVs. So capital allocation, incremental capital allocation is a linear projection right now. I am projecting their Arista track record forward. I'm saying that they will do equally well with the next molecule innovator or the next marketing network that they buy or things like that. They could end up going in the wrong country. Africa, for example, where credit losses, I'm not worried about currency losses because they convert everything, they do dollar pricing. Then those guarantees in open ag, like any insurance company, if you don't understand the probability of failure, you should not be putting out guarantees. So it's a high margin business, provided you know the actual probability of failure. So I would classify all the risks in these three. One, accounting fraud. I think I will bet on the fact that there's nothing wrong with the company. It's all just media hype. So that is my core. That's the first step. Then an insurance company. So an insurance company that buys the wrong probability density function could get into trouble. UPL, I think they know their business. They know their chemicals. They know the impact on the product. And well, if they don't know, then nobody else knows. So they certainly know more than the farmer. So the margins on the open ag business are going to stay. Then credit losses, because a very large part of the company is now working capital. And that is the growing part of the company. So like any working capital, this seems to be the concern even with Redington. The market is paranoid that all their inventory is going to blow up. So it's normal for anybody with a high working capital that the quality of working capital will always remain. It's like appraising a bank. And in fact, that is the part of my core hypothesis. Just like in a bank, we assume that all the interest cost is going to get paid from the balance sheet and not the profit and loss account. Well, in companies like this, the market makes a mistake where it just takes a simplistic EV by EBITDA and marks it down. So why should a company like this not have working capital debt? That's not clear to me.
Okay, thank you. So any other questions? Please raise your hand. Okay, I don't think we have any further questions. So we can thank you, sir, for this 1 hour of total coverage of the UPL stock, because it's a very misconceived stock, like you say, and it's very difficult to understand this company because it has too many moving parts. So I think you have covered it pretty well over this last 1 hour. So I'd like to thank you on behalf of all the participants today. This debate will, like you say, will just keep going on. So we'll see how things turn up in a year or so from now.
Yeah.
So thank you so much. You can have your closing remarks now, and we can finish the webinar off.
Thank you, everyone. I'll be circulating this. I hope TI also circulates this presentation. So if you have any specific, comebacks or
okay,
models.
I'm just going to take one more question. Somebody just raised their hand. Can I do that, or?